In what was otherwise a pretty brutal day in the markets on Friday, you had one stock buck that trend, and that is Walgreens Boots Alliance. The shares were up nearly 30%. That's right, 30% in a single trading day on Friday. Now, the last time we took a look at shares of Walgreens was about a year ago. We've covered this one a couple times on the channel. We predicted a dividend cut was going to come, which ultimately did. We also called this a value trap. We said to avoid shares of Walgreens. Again, after that dividend cut, since then, over the past year, shares are down over 52%, and over the past 5 years, shares are down nearly 80%. Again, that is despite a one-day rally you saw on Friday, with shares up 28%. So we have to break down the stock, see what is going on, because you don't just get 28% rally in a stock based on fundamentals. Now, sure, some of it is due to their fundamentals slightly improving, the fact they came in with beats on Wall Street expectations, but a lot of it is due to the fact that you have an 11% short interest in the stock. And so some of that was short sellers needing to cover their shorts on Friday. And then some of it was also due to the fact that you had momentum traders pile into this one based on the technical. So we'll be sure to break that down. Hey guys, hope you're doing well out there. It's been a while since we've covered shares of Walgreens, and probably no better time than after the stock rallied over 27%. Now, on the surface, you see this one has a 8.5% forward yield and a forward earnings that's less than 8 times. So for value investors, that probably sounds like a dream, a forward yield over 8% and a forward earnings less than 10 times. But anytime you see that, probably 9 times out of 10, when you see that on Wall Street, go in the other direction and run as far as you can, because there's some things that are seriously wrong with this company's fundamentals, and we'll break that down for you in today's video. Now, the revenues in this most recent Q1 came in higher than anticipated by nearly $2 billion. That's a pretty solid beat, as revenues came in nearly $39.5 billion, up nearly 8% year over year, with earnings also beating on the bottom line, with non-GAAP earnings coming in at 51 cents, beating estimates by 13 cents. So anytime you have a stock that's down probably 50%, 60% over the past 1 year, know that the expectations are probably on the ground for a stock like this. And so anytime they come in higher than the expectations, keep in mind those expectations have been revised lower over and over again. And then that's why they've been able to come in with this speed. Keep in mind, probably 2 years ago, 3 years ago, the expectations for the same quarter were probably much higher. Now, earlier on in the month of December, Walgreens jumped nearly 20% on the news that it might be going private and selling itself to a private equity firm known as Sycamore Partners. Then just a couple of days later, in fact, the next day, it dropped as analysts became skeptical on that potential sale of itself going private. And largely, that's due to the fact that you have a challenging pharmacy backdrop. You also have a buyout being harder to understand given its already sizable debt burden and its minuscule cash flows. We'll be sure to look at that when we get to the financials. And then just a few days later, you once again had shares soar on the fact that Sycamore Partners is lining up lenders for a potential takeover worth nearly $10 billion. So you had a bit of seesaw back and forth in shares once this news broke that potentially Walgreens could be taking itself private. Now, in the conference call that happened on Friday regarding their Q1, management was specifically asked about this potential news, and while they didn't address it directly, they mentioned the long-term stories of becoming cash flow positive, reducing operating expenses, reducing capex, and all the things that you would expect management to say. Now, my take on this news is, first of all, if you're playing the stock based on the news of Walgreens potentially going private, that seems more of a gamble to me. It's really not based on the fundamental story at all. In fact, if it was based on the fundamental story, the fact that the potential takeover would be for nearly $10 billion, and this company today now trades at a $10 billion valuation, a lot of that private equity takeover or going private is likely already priced into the stock. And so any potential upside left from the possibility of being taken over is likely limited, in my opinion, at this point. And when we get into the fundamentals, you'll see that there's probably not a very good chance that going private really makes sense for this company, along with any private equity firm that really steps out there looking to buy Walgreens. Now, in terms of the dividend, again, we talked about it at the top. You have nearly an 8.5% forward yield. Before this move, that forward yield was close to 10%, which again looks very juicy on the surface. You can get pretty much a 10% return just by holding the stock. But keep in mind, that dividend had to be cut by nearly 50% in 2024. And I certainly wouldn't be surprised if that dividend gets cut by half again in 2025 or beyond, because the financial situation over at Walgreens looks absolutely dire, to the point where they likely will have to stop the dividend altogether for a couple of years. And keep in mind, this was a company that once had 48 consecutive years of dividend payments and was on the track to becoming a dividend king, now in a very, very dire situation from a financial perspective. And look, I'll paint that out for you. It's really not that difficult to understand. Over at Walgreens, you have $39.5 billion of quarterly sales, which look is a huge number, again, for a company that's trading at just $10 billion worth of a market cap. Again, $40 billion in a quarter in terms of sales is pretty massive. And so from a price to sales perspective, you're looking at just a fractional price to sales. But keep in mind, as you come down these financials, it makes a whole lot of sense why this company isn't valued at more than just $10 billion, because you have cost of sales that grew in line with your sales as well. So you weren't able to generate more gross profit despite adding on nearly $3 billion to your top line. Your gross profit stayed basically flat to the dollar at $6.7 billion. That's where you were in the same quarter last year. So despite raising your revenues, you actually lost gross margin over at Walgreens. Now, on top of that, you have SG&A costs continuing to rise from 6.8 now to $7 billion. And so you increased your operating losses from just about $39 million loss last year to now close to $250 million. And that trickles all the way down to your net loss per share, as that came in at 31 cents of a net loss last year. You lost about 8 cents per share from an earnings perspective. You're also seeing a little bit of dilution from your weighted shares outstanding. I fully expect this company to continue to dilute you heavily in order to just continue operating the business, raise some capital, because we'll see from their balance sheet, they don't have a lot of room to take on additional debt in order to finance their business. And so from a cash flow perspective, from a balance sheet perspective, this is a quarter-over-quarter view, as you have Q4 on the right-hand side and Q1 on the left-hand side, now looking at just under $900 million in cash, another call it $300 million in marketable securities. So you're looking at just over $1.1 billion in cash and marketable securities. You come all the way down to your liabilities. You have about $500 million in short-term debt, and then another $7.6 billion in long-term debt. So just right there, you have just about $1 billion in cash and nearly $7.5 billion in long-term debt. On top of that, Walgreens has a absolutely ton in operating lease liabilities, nearly $20 billion, because they own such prime locations of real estate, usually on the corner of intersections, really where rent, I'm guessing, is not very cheap. They have a ton in operating lease obligations. Now, they did announce that they will be closing roughly 1,200 locations over the next, call it 1 to 2 years. So that should help some of these operating lease obligations. They'll probably close down those unprofitable or very expensive locations first. And so that should help the balance sheet, at least in terms of lease obligations. But again, that turnaround is very slow and very tedious for a company of this size. And lastly, from a cash flow perspective, you come all the way down to operating cash flows of a loss of $140 million in this most recent quarter. That did improve from same time last year, but again, you have still nearly $280 million in capex, and so your free cash flow is looking at negative $400 million. That is for a quarter, believe it or not. So despite what a 28% rally in shares might show to you on the surface, when you comb through these financials, it looks absolutely terrible. There's no other way to put it. On top of that, this company continues to try to pay off a little bit of that long-term debt. A lot of that, again, coming off of their balance sheet, because keep in mind, this company is still free cash flow negative, and they continue to pay out nearly $200 million in cash dividends in a quarter. So what this tells me is this company really has no more room to raise debt. In fact, they need to continue to pay off large amounts of debt. They're really in no position from a balance sheet to continue to pay out nearly $200 million a quarter in cash dividends. And so what I fully expect is this company to not just cut this dividend, but actually raise a fair amount of capital through equity dilution if in fact they don't end up going private. So from a financial situation, there's really nothing to like about Walgreens at this point. They do mention they're closing stores and the turnaround will slowly happen. But from a fundamental perspective, I see absolutely no reasons to come in here and trust management at this point and to take a chance on the stock, because again, that private equity talk is likely priced in. You also have pretty much no moat remaining over at Walgreens, because you have competitors like CVS and Walmart, let alone Amazon, coming here and eating up their market share as well. So that's my take from a fundamental perspective. From a technical perspective, the last time we took a look at shares of Walgreens, it was in this well-defined downtrend of lower highs and lower lows, really over the past 3 years. And yeah, once it was teetering on that lower bed of support at $15, you basically had decision day. If shares didn't move higher, they broke decisively lower, and you see this giant, huge gap in the stock chart. And that's basically a clear sign that the stock is a falling knife. And like so many times here on the channel, we preach, especially when a stock is in such a well-defined downtrend, you absolutely don't come in here. You don't try to time the bottom, and you don't try to catch a falling knife, because you had shares move from around $12 all the way down to $8.50. You had another 30% in downside if you tried to step into Walgreens at this point. Now, in the most recent couple of months, you could make the case that shares are beginning to be in an uptrend of higher lows and higher highs, as you see. With this pattern, there's not a whole lot of convincing candles on this chart though, because you do have large upward candles. You also do have some gaps that I would expect Walgreens to come in and fill as it continues possibly on this uptrend. If you really want to convince yourself that the uptrend is here to stay, you probably should expect a breakout above this upper resistance at $12. If you can come up here close to $12.75, you again have this huge gap up to, call it $15, that has room to fill on its way up. But keep in mind, you probably have a lot of people stuck in this name at very elevated levels up here at $22, if not higher, close to $30, that will likely continue putting selling pressure on shares as it moves higher. On top of that, you still have the fact that this company has nearly an 11% short interest. And so while at times you might see that short squeeze helping you on the way up, I think a lot of times it'll continue to put downward pressure on the stock from a technical perspective. And from a fundamental perspective, still no reasons to continue to step in and be a buyer in shares of Walgreens. I fully expect this one to continue to be a value trap in the near future. Despite what management tells you the turnaround is happening, I think you're still a long way away from recognizing that from a financial perspective. Again, from a dividend perspective, while it looks juicy, I think you can anticipate a dividend cut coming sometime over the next 1 year as well. That was my take on shares of Walgreens, one we've continued to highlight to stay away from despite the low valuation and the juicy dividend yield. Let me know your thoughts in this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.